Transactions not regarded as transfer. Part 3. Now, you know basically that there are certain cases wherein one company, let's say this company as A, goes and amalgamates, or in common parlance you also call this as merger. So one company goes and amalgamates into another company. The company which so merges is known as the amalgamating company. Okay. And the company in which it goes and merges is known as the amalgamated company. It's ED over here, ING over here. Now, when this company goes and merges into this company, what happens is that all the assets and liabilities of this company become the asset and liabilities of this second company, or the amalgamating company's assets and liabilities become the assets and liabilities of the amalgamated company. So you have fixed assets which moves on from here and goes and sits here. You have liabilities which go from here and sit here, and so on. Now, when this movement of fixed assets happen, effectively, if these fixed assets satisfy the definition of a capital asset, right? So if any of these assets is a capital asset, this act by itself results in transfer of this capital asset from A to B, because these are two distinct entities. However, in order to ensure that these kinds of reorganizations, as they are called, are tax neutral, the law provides that transfer of a capital asset by this amalgamating company to the amalgamated company will be exempt from capital gains tax. Okay, let us see the conditions or the situations. There are three situations which we are looking at. Transfer in a scheme of amalgamation, B merges into A. Okay, in my example, I had actually considered A merges into B. So let's say if B merges into A. Okay. Capital assets by the amalgamating company to the amalgamated company if the amalgamated company is an Indian company. So the condition is that this company, the transferee company, if that makes it easier for you to understand, or the amalgamated company, should be an Indian company. So if the merger is happening this way, then this is tax exempt. Interestingly, under the Companies Act, the merger of an Indian company into a foreign company is not allowed. So under the Companies Act, in any case, this company cannot be a foreign company. But anyways, the way the law stands today, it requires that this amalgamated company has to be an Indian company. Okay. First, let's see the third one, and that I will explain to you the second one. This is first, this is second, and this is third. Transfer of a capital asset by the amalgamating banking company to the banking institution sanctioned by central government under section 45(7) of the Banking Regulation Act of 1949. Again, this is something similar to this. The only difference is that the amalgamating company is a banking company, okay, and the amalgamated company which we were discussing is a banking institution, and this has to be approved by the central government. Normally these amalgamation schemes are approved by the High Court of the state in which this company has its registered office. Okay, let us see the second one. Transfer in a scheme of amalgamation of a capital asset being shares held in Indian company by the amalgamating foreign company to the amalgamated foreign company. Now let me explain this to you, because this is a little different. Let's say we look at a foreign jurisdiction. Okay, you have a company F1 over here and a company F2 over here. Now F1 is holding shares of an Indian company. Okay, and what happens is that F1 goes and merges into F2, right? In this case also, now what will happen is that while the legal owner till now was F1, because it is going and merging into F2, the legal owner will become F2. So there's a transfer of shares of the Indian company, but the law actually under this section 47 scheme provides that this will not be treated as a transfer, and hence not liable to capital gains tax if two conditions are satisfied. Let us see what are these conditions. At least 25% shareholders in the value of the amalgamating foreign company continue to remain its shareholders. Okay. What does this mean? This basically means that 25% of shareholders of F1 continue to remain the shareholders in F2. If this is a little confusing, maybe I can just amend this language a little bit for you. At least 25% shareholder in the amalgamating foreign company continue to remain shareholders in the amalgamated company. Such transfer does not attract capital gains tax in amalgamating company's country of incorporation. So this transfer should not result in any tax liability in the country in which F1 is incorporated. Right? If these two conditions are satisfied, that India will not tax such kind of transfer. It will not be treated as a transfer and hence will not be liable to capital gains tax.